Just like with private equity firms or hedge funds, people are amazed by the power and influence of venture capital funds. Some of them are truly iconic, like Sequoia, earning that status by helping the rise of Apple, Cisco, Google, Instagram, LinkedIn, PayPal, WhatsApp, and Zoom. And there are plenty of others for sure, doing the same by investing in companies at their early stages of development. If you do a quick research, you will see that some of the champions in this industry have billions of dollars under management, although significantly less compared to private equity or mentioned hedge funds. And there is a reason for that, and we are going to explain it in minutes. Just like explaining how these firms operate, where and how they invest, how they earn the money, and similar. So what is venture capital? At the essence, venture capital, or VC funds, are specific investment vehicles that play crucial roles in the startup ecosystem, providing the necessary funding for early-stage companies' development, helping them to grow and scale. Just like private equity and hedge funds, they pool capital from institutional investors and high-net-worth individuals in order to invest in high-potential startups and early-stage companies. Unlike hedge funds, which may invest in a wide range of asset classes, VC funds are focused primarily on equity investments in private companies, often in the technology, biotech, and other high-growth sectors. From the organizational standpoint, venture capital firms have a lot in common with private equity and hedge funds. Basically, they are set in the same manner by a venture capital firm or a general partner, raising money from pension funds, insurance companies, other funds, family offices, and similar. VC funds typically have a finite lifespan, usually around 10 years, with the first few years dedicated to investing in startups and the remaining years focused on managing and exiting those investments. So, you might be wondering, what are the core investment targets? As we said before, venture capital funds invest primarily in early-stage companies that have the potential for rapid growth. The stages of investment typically include seed stage. This is the earliest stage of funding, where VC funds invest in startups that are in the concept or product development phase. The capital is used to build a prototype, conduct market research, and lay the foundation for future growth. Early stage, meaning Series A and B. At this stage, startups have developed a product or service and are seeking capital to scale their operations, expand their team, and enter new markets. Series A and B rounds are where VC funds often make their largest investments. Growth stage, Series C and beyond. Companies at this stage have demonstrated significant traction and are looking to further accelerate growth. VC funds provide capital to help these companies expand globally, acquire other businesses, or prepare for an initial public offering, meaning IPO. Late stage or pre-IPO. In this stage, VC funds invest in companies that are nearing an exit event, such as an IPO or acquisition. These investments are typically less risky but offer lower potential returns compared to earlier stage investments. What's important to highlight here is the following. VC funds not only provide capital, but also bring strategic value to the companies they invest in. This can include mentorship, industry connections, help with recruiting, and guidance on scaling the business. The goal is to help the startup grow rapidly, increase its valuation, and eventually achieve a successful exit by selling the company to strategic partners, private equity funds, or via listing at some of the stock exchanges. So, you might be wondering, what's the difference to private equity and hedge funds? Although both VC and PE funds invest in private companies, the stage of development of a target company is very different, early stages versus matured companies. Additionally, VC funds invest via equity raisings or recapitalizations, meaning by bringing in a fresh capital in order to support the development, while PE funds usually pay out the existing owners, enhance managerial team, optimize the company, and then resell it with a profit. On the other hand, hedge funds play mostly with public companies in the form of stocks and bonds, plus with commodities like gold, currencies, and similar, and rely a lot on derivatives like options, futures, and similar in order to hedge their risk. In addition, it's important to explain the investment horizon. Since the target companies need some time to develop, VC funds have a long-term perspective, usually eyeing the exit after 5 to even 10 years when the company reaches its prime. and they are aware that only a few targets from many are going to make it, meaning to become true champions and earn them huge profits. Most others will perform relatively badly and won't be profitable at all. Yet, the yields of the entire portfolio are what matters, not having a single winner or loser. Compensation is another interesting topic. Just like with private equity and hedge funds, venture capital firms are compensated in two main ways: management fees. VC firms charge an annual management fee, typically around 2% of the committed capital, to cover the costs of managing the fund. This fee is paid by the limited partners regardless of the fund's performance. Carried interest. Carried interest is the primary source of income for venture capital firms and is usually around 20% of the profits generated by the fund. This performance-based fee is only earned if the fund achieves a certain level of returns, known as the hurdle rate. Finally, we can say that venture capital funds are a vital engine of innovation, providing the funding and support that startups need to grow and succeed. While the risks associated with venture capital are high, the potential rewards can be substantial, both for the investors and for society as a whole.